There's a couple of ways to do that. I mean, there are actually inverse ETFs which exist. Now, you've got, most of them are levered, which means you can only hold them for a few days at a time, because what happens is, because of the way they're structured, there's a compounding problem whereby, and this happened with a number of people who had played the UNG, which is a natural gas ETF a number of years ago. That's a whole different problem, because they buy futures, and they're constantly buying the next month futures. And when you have this contango where it costs more to go out further, they're constantly paying higher prices for it. And of course, the other thing is the street, the futures markets, the bond markets. They know when these ETFs are going to have to buy or sell, so they're constantly front running them to begin with. So you want to stay away from levered future, these levered ETFs. There are regular ETFs which are not levered, which you can bet against a rise in rates, or you can bet against, you can actually play the other side of the.
So you can buy the inverse
exactly
ETF,
or you can short what's called a TLT. TLT is the 30-year bond ETF, and government bonds and ETFs. There's no, because of the supply, they're not as bad. Government ETFs aren't as bad an instrument as the corporate and the high yield ones I mentioned before. But that's not, you can short the TLT, for instance. And there are a couple which I can't remember, but there are a couple of others that are inverse, like I mentioned, that you can use as well. That's one way. The other way also, I didn't bring this up, but that we use and you can use to protect yourself against this rising rate environment, is floating rate paper. And taking a step backwards, we've been buying leveraged loans, which are senior loans. And they're basically floating rate loans, typically of below investment grade companies, high yield. They're senior. They tend to be secured, where you might have even assets underlying them, but they're senior to high yield debt. They float. They're typically 3 to 5 year maturities, and they typically have spreads of anywhere from 300 to 500 over LIBOR. They usually have, and then you have to get into them, but you want to buy the ones where they have floors, which means the rate can't go below a certain. There's a lot of nuances here, but floating rate loans or floating rate leverage loans are another way that we've used to kind of protect ourselves. Yields in those things are in excess of 5% also right now, so you're not getting a bad return. And if rates do go up, the coupons on those will adjust higher over time also. And I know that's kind of off the beaten track, but that's another way to protect oneself as well against this fear of the rise in rates.